Today is Monday, May 10th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Dave Hightower, President of the Hightower Report, and Steve Freed, Vice President of Grain Research at ADMIS. Dave, let's start with this. How do you see inflation in the U.S., and what might be the pattern with commodities and the Federal Reserve?
Well, the Fed has indicated this full employment objective. The question is, will they relent when the inflation pressure gets up to a certain point? And secondly, will the halting of bond purchasing and hiking interest rates stop a inflationary spiral that's taking place in commodities and wages and just even services? Today we had Chipotle indicate they're raising wages and they're going to try and hire 20,000 people. And we're having trouble getting workers in the restaurant area. And that's why the non-farm payrolls were as soft as they were. So we may be into something that's a little different than what the Feds had to encounter. And they upped the ante even one further because they said, look, we need to, we also need to make headway on minority unemployment. And so they seem to have several different objectives that are all concentrated on growth. And they are inviting inflation now. So they're going to light the candle. We'll just see if there's some way for them to pull back on the reins.
So there's a need for employment. Dave, I've heard some reports that some of the unemployed are actually making more money with the stimulus monies and the unemployment combined than they would going back to work. Do you think that's going to be a detriment, as far as these companies who need to hire a lot of that lower earning wage, employees?
Well,
Like the
guess
fast
what?
food industry, for instance.
Yeah, I mean, they're going to have to up the ante. Is what they're going to have to do. I mean, if you're wanting to reopen and go back to capacity, and think about it, those are one of the lower costs is the lower level employees, and so you're going to have to raise the wages. If you want to be open, you got to raise wages.
Steve, let's turn to the grain markets really quickly here. Grains and oilseeds scored new highs last week. Why?
I think that there was some managed money and funds that came in and started buying hard assets, to hedge against inflation, whether it's the grains or the metals. And I think that that was new money coming in. Plus, it continues to be dry in Argentina, and we think that that's going to help our corn export demand.
And Steve, I know the next report is Wednesday. What are your expectations and what type of price impact might we see from Wednesday's USDA report?
It's a very critical report. I think the reaction is going to be extremely volatile. Up until now, the USDA has been reluctant to increase U.S. corn and soybean demand and lower the carryouts. But I think they may be, at least in corn, forced to increase export demand and maybe ethanol demand and lower the carryout. And more importantly, they'll come out with their first 21 and 22 U.S. and world supply and demands. If they use some of the outlook yields and the latest acreage numbers, they could have a corn carryout for next year of 1 billion bushels and a beans of 25 million bushels. And we also note that crush demand is going to be up next year because they may use soybean oil for jet fuel. And if the Brazil crop is smaller and China takes more corn and beans next year, we could see 400 to 500 million bushels more corn exports next year. So USDA's kind of painted themselves into a corner being conservative, but some people think that this report could be friendly. If it's not, we could see more fund liquidation after the report.
Dave, Steve mentioned Chinese buying. What's your outlook for demand out of China for U.S. agricultural products here, in 2021 and 2022?
Well, I look if you want to get a neutral or unbiased type of look on that, you got to look at what's the wave of buying in iron ore and steel and copper and these other unrelated, because China has a tendency to do its restocking it all in a wave. I mean, they put it in their plans, and it seems to me that those have not stopped. Copper at one time today was up 17 cents. And so I think, we're going to continue to see that very strong, and our dollar is going down. And so that should, if you don't have supplies in South America, then we're kind of sitting in the driver's seat. And one thing about the USDA report, typically we don't get this kind of volatility early. And so we're kicking this off this year. And by the time we get to July 4th, we're going to have a lot of volatility in our rear view mirror. Pretty wild swings with these prices.
Dave, I think we're all paying a little bit more for gasoline right now. I think we're seeing it at the pumps across the country. Can you please comment on the gasoline situation and the supplies leading into the summer?
Yeah, so the oil industry did one heck of a job in terms of I don't want to say manipulating, but controlling the stocks and the inventories through the biggest demand destruction event that we've had in modern history. And a lot of it was because we shut down the oil patch, but the refiners held back, and we had the only time we've had these kind of low refinery output numbers was when you have the double hurricane in the Gulf of Mexico, and it actually damaged and shut down 4 different facilities. So they've been very effective in managing where the inventories were, and they left them tight. The distillates, which have the worst demand because of the jet fuel, lack of jet fuel use, these markets are tight. They had the worst demand structure and they're tight. So now in the gasoline market, we started to loosen. We went from some 70%, 30% of the refiners idled. Now we still have 14% of them idled into the beginning. We got 3 weeks and we're in the beginning of the kickoff season. And, there is this bounce back demand for gasoline. I mean, people that have been in their house for all this time are going to want to get out. And the airfares have went up so much, you're going to see this concentrated relief kind of gasoline consumption. And so we come in here very tight with 17 million barrel deficit. And we may see demand reach 10 million barrels per day. So it's a very incendiary situation. It's classic supplies tight. And now we're going to see the most concentrated opening up type of consumption of gasoline. So you never know. We could see another 20, 30 cents on the upside in the gasoline price.
Thank you. Let's finish up today with some feelings on the stock market here. I mean, we had a kind of a negative unemployment report on Friday, yet the market rallied to near all-time highs in all 3 segments of the stock indexes. What's your thoughts on the stock market right now, Dave? And I'm pretty bullish out there.
Yeah, and it should be because the lack of alternatives are still out there. The interest rates are very low. And by the way, I think that the Fed is orchestrating the hold down. They're holding down the yields in the futures markets, I believe, because we're seeing data that should have really hammered prices, and yet on those days they're rallying. And so you have the Goldilocks environment. You've got good numbers. You've got the Fed saying, look, we want inflation. You've got just finished a huge earnings cycle in which they were really knocking it out of the park, and we weren't really opened up then. And so, there's a lean and mean description. They've laid off, they've trimmed their costs, they've got all this unnecessary expenses gone, and you get back into a normal business cycle after huge earnings. Then all of a sudden you get this massive justification for even higher earnings and PE ratios and so forth. So, they have someone running interference for them right now, and that's the Federal Reserve.
Thank you both very much, Steve and Dave. Appreciate you being with us today. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.